Hi, everyone. We're just going to give everyone a chance to make their way into the webinar. Usually takes a minute or so until everyone makes their way in. So we'll give it a 30 seconds or so, and then we'll get started. We'll just give it another 20 seconds or so, and then we'll get going. I think there's a few people still making their way in. Right, I think we can get going. We've got a lot to get through, so the sooner we start, the better. So thank you everyone for joining us. This is the first P1 webinar of 2026, and we're going to be looking back at the final quarter of 2025, and really we'll make some comments about the calendar year as a whole. I'm James Fashea, Senior Investment Account Manager here at P1, and with me, as always, I have our Chief Investment Officer, Will Dixon. He'll be taking us through the majority of the content today. If you haven't joined us before, a heads up that we ideally try to keep these sessions as interactive as possible. So please, if you have any questions, there's a Q&A area which I'll be monitoring, and so feel free to stop us if you have a question. In terms of agenda, there'll be a macro and market update. We'll then dive into currency as a topic, focusing on the dollar, and as always, we'll chat through a few P1 portfolio updates. If we have time, I'll also make a few market and portfolio comments, and I'll also share some P1 news worth being aware of. Lastly, CBD points, we will be sending you certificates for attending. We'll be sending those out in the coming days. That's it from me for now. Will, over to you.
Thanks, James. Thanks, everyone, for your time today. I think our choice of topic today is very relevant, just in terms of the focus on de-dollarization. It seems to be increasingly entering the news over the last few days and week or so, since we thought this was a good idea to talk about. So yeah, hopefully that's very timely for everyone. But just looking at the last quarter and what markets have done. So this is the last 3 months, looking at equities, gilts and corporate bonds. And really, I think that the key takeaway, if you recall, perhaps if you joined the last webinar that we had, it was a very strong period for equities, in particular during the second quarter and third quarter of last year. The fourth quarter was slightly different. Not that it was particularly bad for equities, but it was much more normalized, and they didn't particularly outperform meaningfully other asset classes and fixed income that we've got here. But I think the key feature change that we saw within equities was really the return of volatility. And you can see we've had a few short bouts of it during that final quarter of last year. A lot of it was Trump driven. So these abrupt changes in policy, surprising markets and then being walked back. But it does also suggest that perhaps there is some nervousness from equity investors, that they are perhaps looking for reasons to sell off. But equally, there is still strong support to buy the dip when those do occur. Just looking back over the year, and I think this is important, just to put it in perspective, because I think people do forget the first quarter. We had a very weak first quarter of the year. So from that February peak down to the to the Liberation Day announcement in April, there was an over 15% drawdown in equity markets, and then the rally has been quite extreme from that point. So over 30% gain from the lows in April, and I think that's why the general consensus, perhaps if you ask people what last year felt like, it was generally a positive year. But it's just to remind people that it wasn't all like that, and actually obviously there is risk from holding equities. You do get these significant drawdowns, and actually the drawdown from February March wasn't necessarily entirely driven by US policy change. That was obviously the final leg down at the beginning of April. The second point I would take away from this is actually just how attractive perhaps fixed income has been over that year. And that's not to say you've generated a really high level of returns and those have been competitive against equities. It's actually that they've delivered perhaps much more what you would expect them to deliver. So yields on government bonds at the beginning of 2025 were probably around 5.5%. And they delivered a return on the red line there of 5.74, and equally on corporate bonds, very similarly, you do get a premium for owning those, and the yield would have been 6 to 7%, and you've got a 7% return. So it's just illustrating that actually now we've got proper bond yields from fixed income. They're much more reliable and underwrite that steady rate of return that you should expect from the fixed income allocation of a portfolio. And obviously helping to dampen some of that equity market volatility as well. Just very quickly, some of the key points that we look at when making decisions. Clearly, equity valuation is quite high up on the agenda, and this has been a feature for several quarters for those of you who've joined us before. I think the good news that we've had over the last 3 months is that equity valuations haven't continued to rise. That being said, they do remain at elevated levels. So we are looking at a premium of around 10% against history from the equity market. It is in the top decile of equity market valuations. And we have looked at charts before that just illustrate that although that's not informative necessarily over the next 1 year of returns from equities, it is very informative if you look further out to 5 or 10 years. It does become a significant headwind to what you can expect from equity markets from a total return perspective. So we remain cautious on equities. That's not an extreme view, but we do feel that there are better areas of capital markets that we can be tilted towards at this point. Also worth noting, I think, as everyone is well aware, that the US equities do remain at a premium to other areas. But what we have started to see is that particularly emerging markets have begun to grab the attention of investors, and we have seen valuations begin to creep up from very low levels in those markets, and potentially beginning to converge on where the US and others are from a valuation perspective. In terms of the overall health of the economy, it's still a fairly mixed picture. There are some data points that suggest that growth remains robust. So, for example, the final quarter reading in the US suggested that you were getting an acceleration in GDP growth towards the end of last year. Looking at unemployment, and this is consistent whether we look at the US as we've got here or in the UK, unemployment has creeped higher from extreme low levels that we saw post-COVID. So the rate was down below 4% and has crept up to more like 5%. We're at 5.1% in the UK. It's difficult to determine whether we're at the point where this becomes a self-fulfilling spiral upwards. As you can see in past scenarios, we've had you have this gradual increase in unemployment that then becomes a rapid spike as it becomes self-fulfilling, where you have people losing jobs and therefore not spending money on other goods and services and resulting in further job losses. There is obviously a narrative here that with the adoption of AI through the economy, there are potentially fewer jobs being made available, and that's what's resulting in this increased unemployment rate. Obviously not good news for those people without jobs, but that's potentially a positive longer run story there where productivity is enhanced. So in terms of our key judgments that we looked at the beginning of this year, I think looking back perhaps 4 or 5 months, this first point on US policy volatility, we perhaps considered was beginning to become less of an important feature, but I think that's been firmly put back up at the top. And it's incredible to think that so far this year we've had Venezuela, we've had Greenland, and it feels increasingly likely that there's going to be some form of US intervention in Iran, just from a geopolitical standpoint. So US policy volatility, and then from an economic perspective on tariffs, it's quite clearly that this is at least short-term market sensitive and something that we should be wary of. I think I'd definitely step away from attempting to get inside the mind of Donald Trump and when and where and who he's going to hit and how fast anything is going to be unwound. But there's certainly volatility being introduced to markets as a result of these rapid policy changes that are occurring. And I think it links in with what we're about to talk about in a moment, which is potentially the breakdown of faith between international investors into other economies. And I think we're beginning to see the start of that, particularly between Europe and the US, triggered or perhaps pushed over the edge from the Greenland disputes that we've had recently. The other points here, which again, I think the debt concerns point really also does link into the de-dollarization topic that we'll get on to. But really this very long-term increase in government debt, the lack of incentive and appetite of politicians to address the increase in debt does mean that we should be wary of certain assets and certain features over the coming years. And this is, I think, a multi-year, if not longer, trend, where actually for investors, long-dated government bonds may, or they certainly have increased risks. There may be points in time that they are attractive, but we should be wary, and they rightfully do trade at a premium yield now. Global growth deceleration, as I said, it's a mixed picture, but there's certainly an increased risk that this deceleration in some areas does tip over into a broader recession, and what impact that would have on different asset classes is clearly a negative attribute to equities, but may well be positive for some fixed income allocations. Equity valuations we've covered, and monetary policy and inflation. So I think there are two parts to this. There's the short-term picture and the long-term picture. Certainly the short-term, the general trend is that inflation pressures are easing, and monetary policy will gradually loosen as a result, particularly if we link that into the global growth deceleration point. There would be scope for interest rate cuts. But actually, longer term, if we do continue to have debt concerns, if we do continue to have currency volatility that we're beginning to see, actually inflation is likely to become more volatile and higher than perhaps the target rate that is put out there. So overall, we're maintaining our general risk off stance, the modest one, which is broadly an underweight to equities. Within fixed income, preferring high quality bonds over credit and high yield. And then really the bigger, the positive allocation is towards real assets, infrastructure within alternatives, which we feel have attributes that address many of these points. I guess I'll just pause there, James, in case anyone's dropped anything in.
No questions just yet. Well, I think I always make this point with the macro stuff. I think everyone gets bombarded with a lot of macro
Yeah,
commentary. So I think it's just looking at the facts, and you've put the facts down as we see them. So I'm sure there'll be questions that come along regarding the portfolio updates and that detail.
great. So really, the focus of today is to focus in on the de-dollarization story. Is it happening? And ultimately, the key point: what should investors be considering as a result? So I guess the first question is it happening? Are we seeing evidence that de-dollarization is more than just something that people are talking about? This is the dollar index, so it's the US dollar against a basket of its major trading partners, so things like the euro, the pound, the yen, etc. And so we've seen that there has been some weakening of the dollar. I think if we extended this by another week or two, we would see that this is probably down to around the average level that it's been over the last 3 decades that we've got on this chart. So it suggests that the dollar was probably high and has come back to a normalized rate, but perhaps not that it's had a disorderly sell-off yet. Although there's obviously perhaps more commentary over the last few days around that topic. And then from a valuation perspective, what does that look like? And I think perhaps this is a bit more compelling to suggest that there's more to go. Against the majority of peers, the CHF at the end here is the Swiss franc, so probably not a particularly major trading partner. But against most major economies, the US dollar is overvalued, and it's by about 10 to 20%. I think it's really notable. The Japanese yen negative column here that is almost 50% undervalued versus the dollar, which does feel like it's at an extreme level. And I think over the last couple of days we've had speculation that there will be currency intervention to resolve that. But I guess the overall point of this is to say, well, the dollar is expensive, and that there is potential for it to fall just to get back to a more competitive long-term rate. And that 10 to 20% is meaningful if you are perhaps owning dollars in an unhedged basis as a sterling investor.
Sorry, well, do you mind just going back to the previous slide? I just want to highlight something because it just ties into the bigger picture, and I'll be putting up a longer term picture of the S&P 500. And it's just interesting to me if you look at the period from around 2000, January 2000 to 2010, you can see the devaluation of the dollar there over that period, almost a decade long period. And in my S&P 500 slide that we'll look at later, the S&P 500 effectively did 0% over that period as well. So I guess is the de-dollarization, does that end up being a poor performing American market? Does that end up translating in a poor performing American market? It's an interesting one.
Yeah, I think I've got a chart just on that point that essentially if a weakening dollar is a headwind to a foreign investor investing into US equities, because out of every market is the most domestically focused, as you would expect as the largest economy. It's the opposite of what people say about the UK market, in that the FTSE 100 has 70-80% of revenue is from outside the UK. So what are again, to the topic of are we seeing trends that de-dollarization is happening? And perhaps the first indication of this is by central banks. And this is just showing how much of central bank's reserves are held within US Treasuries versus gold. Obviously, it doesn't sum to 100. There are other things that might be in this basket. But just to compare the two, we've had a long period of time here. So that's the late 90s through to 2020, where it was a relatively stable component of central bank reserves were in US Treasuries. And I think if you try and get into the headspace of what a central bank is trying to do, they want something that they can reliably draw upon in times of crisis to perhaps support a currency and general financial stability within that country. So if there's any breakdown in belief that they can get hold of that when they need to, they may well at the margin not want to hold that asset. And I think what we've begun to see over the last 10 years and increasingly over the last year or two is that people don't believe, from a prudent perspective, that they can get hold of treasuries that are custodied in the US. They're obviously they're at the whim of the US whether or not they want you to have them in truth. So they're preferring to hold gold in custody within their country that they can then have faith that they can sell that and perhaps do the things that they need to do as a central bank. So yes, we are seeing de-dollarization arguably by central banks already, and it's been a long-term trend. It's perhaps only just been more recently being picked up over the last year more broadly. And then I guess the second question is, how far has this trend got to go? And if it is gold that's being used as the alternative, I think just the striking thing about this map is just how little gold, say, China has within its central bank reserves. They've historically been very happy to just put all their excess capital into treasuries. And the trend, probably the biggest driver of the previous chart we've just seen, is that China's been pushing that into gold predominantly. But actually, as the second largest economy, they have a surprisingly small amount of that at the moment. And I would argue that they probably would need to, by several magnitudes, increase that holding. So there's a long way to go, and they're not alone. I think India would be another one that you draw out as a fast-growing economy. They obviously have a cultural affinity with gold, I would say, major buyer within the population, and they have a pretty much stated neutral stance on a geopolitical front. So they want to be able to have autonomy, and you can't really do that by holding someone else's government bonds. Another tailwind really for de-dollarization is the belief that some of this issued government debt can be repaid ultimately. And as I said towards the start, there is no real political appetite, particularly in the US. The fact that deficits are persistently wider than they can be sustainably, and that is driving a higher government debt, is probably only being contained at this point because you've got a strong tailwind of nominal GDP growth. So that's real GDP plus inflation. So we've had high inflation. We've also had reasonable GDP growth, and that's contained that debt to GDP over the last few years in an environment where the deficit has been 5 or 6% every year since COVID, and is getting worse. So there is now a growing distrust that will be addressed in a fiscal consolidation, so something like austerity, and is more likely to be addressed through longer periods of above normal inflation. And in that environment, you don't want to own the currency. It's a slow debasement of the currency. So they then look for alternatives. Obviously, one of those is gold. Another one might be things like real assets and even equities. I think you could perhaps argue some of the resilience in the equity market has been driven by the fact that it is not dollars. Gross issuance is at an extreme, and this is a slightly nuanced point, but a lot of the refinancing of the US government debt is done in very short-term time periods. So they're issuing a lot of one-year bonds and below rather than 30-year bonds. And that's mainly because it's cheaper for them to issue shorter. But what it does is it creates a very high vulnerability to a change in market sentiment. So if the market doesn't want to fund, perhaps in a particular month, further issuance from the US government, there's going to be an immediate repricing of that debt. Whereas obviously if you have lots of long dated debt, it's less of a concern. It doesn't have to be repaid for many decades in some instances. As I said, longer term concerns around exit strategies. I think inflation, long run inflation being higher is certainly the concern. And I think probably the tipping point this year has come from the Trump factor, as I put here, but it's the breaking down of faith between foreign investors owning dollars at the margin. For several decades, foreign investors they've flocked to the US. US assets have performed very strongly. The US dollars performed very strongly. It can be relied upon as an international partner. There's also been the rule of law where you can trust that you're going to get back what you've put in ultimately. I think there's now just this growing doubt. Perhaps it's a small doubt, but the fact is that currencies do require faith, that you will treat everyone fairly. And really Trump is going around destroying that faith that's been in the US dollar. This recent image here of the US flag over large parts of North America, I think is probably quite illustrative of that. Would you want to be a Canadian institution owning lots of US dollars if you thought effectively one person could decide those are now frozen? And obviously that's something that perhaps the Russians or the Chinese would perhaps be more fearful of as well, given actions over recent years. The second bullet point here, that Donald Trump is incentivized and has shown that he almost wants this to happen. He wants a weaker US dollar. Is not an incentive for then investors to be buying into it. Let's put it that way. So there's a line up between his incentive and his actions, and then an increase in distrust between international investors in the US. So that all of these factors are, I guess, tailwinds to this narrative. And this is the chart I was talking about, James, earlier. It feels like quite a complicated chart, but really the arrows up and down are the ones to look into. Ultimately, with the lines going up, the dollar is weakening and emerging markets are outperforming other global equities, which obviously predominantly are the US. So lines going up from 2000 to 2010. So that's where the dollar is weakening and emerging markets significantly outperformed developed markets, predominantly the US. And then we've had this period where the S&P 500 has performed very strongly, which has actually been a period where the dollar has also strengthened as well. It's a fairly close correlation. So I guess the narrative is if we're expecting the dollar to weaken and to have this decade or so long trend of weakening, it's a reasonable conclusion to presume that emerging markets will outperform, or maybe more specifically that the US will underperform. And just focusing on fixed income briefly, the concern around high levels of debt and potentially higher rates of inflation over the long term has already impacted what investors are demanding for longer dated bonds. And again, just to zoom in on the line that really matters here, the red line, that is the premium that investors are demanding for a 10-year bond over a 1-year bond. So you are getting paid almost a 1% premium now per year to own a bond for 10 years than you are to own a bond for 1 year and just roll it over every year within that period. There's no real logic to that other than you don't trust that over that 10-year time horizon, something's going to change to the value of the dollars you're lending. So it's really a inflation hedge premium that's being priced in there. If we had a 30-year chart that was equivalent, this would be more like 2%, which is a significant amount of extra yield that you're getting to lend for longer, which is why governments are choosing to issue shorter bonds now. And that's really illustrated. This is the US yield curve. You can see there the difference between the 10-year and the 1 month at the beginning of this chart, and then it's more extreme towards the right for the 30-year bond. So this is what we considered, and I think what advisors and other investors should consider when talking about de-dollarization. If we agree that it is happening to some extent, and there's certainly a risk that it could get worse, it's very important to have diversification between and within asset classes. So what do we mean by within? I think clearly within something like equity allocation, having other regions within your equities are away from that very dominant US component of equity markets makes a lot of sense. There's doesn't appear to be a huge amount of downside from doing that. And also within fixed income, US Treasuries are a large component of a fixed income allocation if you're broadly market cap weighted. You may even have direct US Treasury allocations. It's very sensible to be broadly diversified within fixed income as well. And I think that goes for any country. You could include the UK in that bucket. And we've obviously experienced UK specific fixed income risks as well. The second point, using alternatives, and this is, I think, where we really see potential for added value and strong diversification benefits. So, I mean, gold is now a very well-known and well-trodden path for this story. I think it's worth noting that I think we put our allocation in. It was probably around COVID period where bond yields were very low, money supply growth was very high, and we expected inflation to ultimately be a problem at some stage. I'm not going to try and sit here and predict what the price of gold is going to be. We're in very much uncharted territory. But I think the more interesting story is really looking at other real assets, potentially other commodities, which can protect the value of money over time, regardless of what happens to the value of that money. Within fixed income, I think with this, the caution over the long end of the curve definitely needs to remain. That's not to say it's uninvestable, but certainly we should be demanding a premium for longer duration fixed income. And then I think we should also expect that we will get greater divergence between regional market performances, perhaps sectorial market performances, as well as currencies, which we haven't really seen over, I guess, probably pre-COVID. So between financial crisis and COVID, was a relative stability between currencies and regions and monetary policy in particular. I think we should expect that to change. So again, I'll just pause, James, in case anyone's got any questions on
that. No questions have come in, but I guess the obvious question would have been, how are we thinking about portfolios considering the potential risk of de-dollarization? And you've already answered that, but I'd say curious about gold specifically. Clearly, we've done well holding the asset class, and a lot of market participants would be asking, would be putting their opinion as gold being quite overvalued, and there's a discussion around that. And I think you and I recently had a discussion around or potentially diversifying away from gold into commodities as a broader basket. I know platinum group metals and silver, for example, are becoming topical. What are your thoughts around that? And
Yeah.
are we considering taking profits from gold, considering where it's sitting?
Yeah, so I think the through rebalancing quarterly, we have effectively been sellers of gold through this whole rally. So for example, the rebalance at the beginning of the quarter, I would imagine we probably sold between 0.5% and 1% of a portfolio value of gold, because it had done so well relative to other holdings. So that's a distinct difference to changing the percentage weight within a portfolio, which we've held steady. And I think it's worth just to reiterate that the reason we've got that in there is not because we think gold is going to go up 50% every year. It's more that it is protecting for the type of scenario that we're seeing playing out, we've just discussed, but also as a diversifier. So we want that rebalancing action because it allows us to crystallize something that is diversified against other things when it's done well, and vice versa. We'll top it up when it falls through rebalancing. I think we probably could have constructed an incredibly good argument every quarter for the last 2 years, maybe, that the price of gold was too high and that we should sell some of it. It is ultimately a sentiment-driven asset. There's no tangible fundamental value to it. But the tailwinds of many of the things we've just discussed, I wouldn't. There's very strong momentum. I wouldn't be surprised if we sat here in 3 months and it's higher again. That being said, we have crystallized a good amount of it. And then on the commodities point, I think the real interest is probably outside of the precious metals environment. Obviously, silver's just done incredibly well. I don't think we'll probably be adding that in anytime soon. But the broader industrial commodities basket is probably of more interest, where that's potentially as a hedge against us being wrong in the expectation that economic growth is going to be weak. So perhaps we will have a boom period in the economy, and AI will pay off massively, and we'll have 5-10 years of exceptionally good GDP growth. In that scenario, something like copper, iron ore, etc., may well do quite well, but it will also have those protective features against monetary debasement or long-run inflation. So it's an interesting addition. I'm not saying this is a replacement, but addition to the infrastructure and gold elements of a portfolio.
Okay, thank you. We do have a question from Kevin, the classic asking for a friend. He's asking for a friend in the US. I think we may need some clarity on this question. I'm not sure if you can see the Q&A box, Will, but he's asking for a friend in the US. What about holding euro and the Norwegian krone and yen? I think we may need some more clarification on that, whether he means hedging away from the US dollar. I mean, any comments from you, Will?
Well, yeah, without knowing the specifics, I think going back to that relative valuation chart towards the beginning, the yen is incredibly cheap on a comparable basis. I'm not sure about the Norwegian kroner off the top of my head, but ultimately the euro, probably less so after the last few days. I think it's re-rated by 3 or 4%, but has been good value on a purchasing power parity basis compared to the dollar. It's worth noting that these are really decade-long trends. So it depends on your time horizon rather than, they're not short-term trades, and things can be expensive for long time periods. So, great.
Cool. Sorry, Will. Yeah. So sorry. I know time's ticking along. It's just a question from Andrew Hammond here, and I know currencies are. I mean, they're hard to call. and I guess they're not always the driver of portfolio construction, because I mean, if you just look at the US market, there's a lot of companies in there that are, their revenues come from currencies that are not the dollar. So it's volatile and difficult from that perspective. But Andrew's asked, do we see a general debasement of the US dollar, not akin to the Bolivar, but enough to be of concern?
Yeah, I think that's why we've seen everything do quite well, because I think people aren't happy to just sit in a currency that they're sort of seeing those risks that we've gone over. High levels of debt issuance, inflation's obviously been a problem recently. There's a general political narrative to spend indiscriminately, and that's not just limited to the US. And they're therefore going, well, what can I can hide in assets, I can hide in real estate and gold and equities and other things. So I think that's why the price of everything's gone up, because people aren't happy to go to the bank and leave their dollars in a bank account. And I agree, I don't think we're going to get hyperinflation and it will just be worth nothing. But do you get 3 or 4% inflation every year for the next 10 years on average? Possibly. In which case that has a meaningful impact on your investment assumption.
Cool, thank you.
So yeah, just quickly on these, because I don't want to take all your time, James, for your section. But I think, yeah, 2025 overall, we've got our asset tracker and wealth accumulator moderate portfolios on here versus benchmark. So it's been a good year for us across both passive and active solutions. Clearly, a big driver of some of that outperformance has been that gold position. So that perhaps half of that outperformance would have been driven from that. Within equities over the last 3 months, I think, as I mentioned earlier, it's Asia Pacific and EM that's been driving that, which again is probably a narrative that's not quite been picked up as much as it should have been, because everyone's been used to this story of the US basically knocking the lights out every year, but that's not been the case over 2025. And I guess to add to that, the UK large cap equities have been notably strong performers, and I think probably are now beginning to attract attention from international investors. Some detractors, so things like infrastructure and fixed income, they weren't negative in absolute terms, but they were laggards against that equity and gold allocation. UK small caps were definitely a headwind, although I would say over the last month or so of last year and continuing into this year, we have seen them actually start to capture some interest, and they've done quite well over the much more recent past. And in terms of changes from a top-down perspective, we've persisted with our view that was implemented at the beginning of last quarter. So that's a lower risk appetite, where we've reduced equity allocation slightly on high valuations and slowing growth, and that's been tilted towards real assets, which is just really leaning into everything we've discussed today. Within equities, the changes that we did at the beginning of this month, within active portfolios, we have also looked to increase the use of quality style funds. So those are funds which we would expect to outperform during weaker equity markets, and they have been particularly unloved over the last few years as well. So they generally is a lower cost area of the market. Within fixed income, we've increased duration slightly. That's really on falling interest rates and some of that premium yield that you're now seeing within modestly longer durations. We're not buying 20, 30-year bonds. It's more like 5 to 10 years. And then there's been some fund switches as well. But in the interest of time, again, I'll just pause before your section, James.
Great, thanks, Will. No further questions have come through. I mean, I'm sure there'll be some that arrive if there are any more. But yeah, let's just in the interest of time, let's move forward. And I guess just from my side, I'll continue each quarter to almost pick on a similar topic. Last quarter, we looked at definitely a zoomed out picture of the S&P 500 and monetary policy in general. And it almost ends up opening up a bit of an active and passive discussion. I don't want to use the word debate, but more of a discussion. And I'm going to enjoy over the coming quarters just planting some seeds into that discussion and testing some assumptions in terms of where clients' capital should be placed and just some thinking around the different solutions that are available, specifically for well, when it comes to the difference between accumulation and decumulation type clients. And I think, I mean, internally at P1, everyone individually has given some predictions for the year ahead for 2026. And although obviously we are in the retail investment space, we are multi-decade investors. We're managing people's capital, not just for the next year, but for multiple decades. So it is those long-term numbers that matter. But I guess a nice fun exercise to make some predictions for the year ahead. And my particular prediction for the year ahead, and also reflects back on last year's, I think potentially we'll look back at the years 2025 and 2026 as a bit of an inflection point for where the market starts to increasingly take notice of real assets and really the fundamentals of instruments, and hopefully I further that point over the coming slides. But certainly an argument can be made for the defining shift of 2025 when it comes to markets is the US aspect underperforming the rest of the market. I mean, some figures there: gold in US dollars giving you 64%, developed markets removing the US market at 32%, emerging markets 31%, and the S&P at 19%. So again, although it's a short period, the calendar year, that is a change of guard compared to the last almost 13, 14 years, really, since the global financial crisis. And a decent segue into the next slide. Again, going to continue picking on the S&P 500, not to say that I'll be right or wrong looking forward, but more just to add some color to the discussion. And there's something called the lost decade. So this is the S&P 500 going back just before the dot-com bubble. And I mean, we know where we've come from more recently. I just mentioned really it's US markets that have driven returns for a long time now. Really halfway through 2011, markets took off, and specifically the S&P 500. But it's not really a story of the S&P 500. It's really a story of a concentrated market where initially it was the FANG stocks. The FANG saying was coined: Facebook, Amazon, Netflix, Google, etc. And more recently it's the Magnificent Seven. It's the same principle. Markets have been driven by a narrow amount of stocks, and it has been those mega cap tech stocks. But I find it so interesting to zoom out pre-2011 and specifically focusing on what's called the lost decade, where really from 2001 to 2011, US markets did 0%. And it was interesting. That's why I pointed out on Will's currency slide how the dollar devalued in the early 2000s, and that did impact the market at the time. And then obviously you had the global financial crisis to 2008 and 2009.
Yeah, I think it's worth noting is this chart is in sterling. So yeah, it's that probably as a US investor you might have thought it's gone up by maybe even 10%, but actually for a sterling investor, yeah, you've had that headwind, haven't you?
Spot on. Yeah, no, exactly. So I mean, post the global financial crisis, well, during the global financial crisis, we had monetary policy being influenced, quantitative easing. And so I'm going to make the point that really post 2011, the market run-up that we've seen from the S&P 500. I'm going to use maybe it's slightly controversial, but the word I'll use is abnormal. And the next slide, I think, makes that case well. If you look at US interest rates over time, this goes back to 1954, really zooming in on that period from 2000 to present. You can see around 2008, 2009, the global financial crisis, interest rates hit the floor. And that's where I'd use the word abnormal. And there's a few things to point out on the slide. Well, you might have to, because I'm not in control, you might have to hover your mouse over particular years that I'm focusing on. But essentially, yeah, 2008, 2009, the global financial crisis happened, and central banks in the West stepped in and effectively started printing money and affecting monetary policy, or influencing monetary policy for quite some time. And it's quite interesting if you, I mean, I'm from South Africa, and our neighbors, Zimbabwe, back in the day also printed money, and they had hyperinflation and their currency meaningfully devalued. So that's always a bit of a risk when it comes to a monetary policy being influenced in that way. But you can see how long interest rates were at 0%, close to 0%, and effectively in that environment, money is free almost. If you want to access debt, you're paying close to 0% interest rates. And so that does pump liquidity into the system, and it does increase, in hindsight, we know that it can increase asset prices. And I guess there's a strong argument for monetary policy being a tailwind for specifically the S&P 500 from that period from 2011. And essentially, an interesting metric is, I mean, the allocators of capital. Why would you allocate capital to cash if you're getting close to 0% yield when the S&P 500 over that period was yielding you 2%? So forget about the capital value of the S&P 500. There was a 2% dividend yield coming off it. And so, I mean, smart allocators of capital would have been chasing that yield. And we know that that's what happened. And so that's almost self-reinforcing. And we know what the capital value was doing at the same time. So very interesting aspect to consider. And then just prior to COVID there, you can see it was normalizing. It went from QE, quantitative easing, to QT, quantitative tightening. And interest rates started being increased. And then COVID happened, and in walked central banks again and implemented QE. And there's a key difference there between QE around the global financial crisis and COVID, in the sense that the global financial crisis, it was mostly banks that were bailed out, where in COVID, households actually got cash. And typically when households get cash, that there's an argument that becomes inflationary. And again, this is all with hindsight knowledge. We know that inflation arrived 2022 essentially, and interest rates had to follow. And now I think we found ourselves in a more normalized monetary policy environment compared to that period since the global financial crisis. And I'm interested, and I think there's a strong argument into how that's translating into asset class performance, and how portfolios are starting to perform considering a more normalized interest rate environment, not just a normalized interest rate environment, but having inflation in the system as well. And I think the next few slides, you'll see that in portfolio performance coming through strongly. So this is looking back to April 2017. It's comparing the S&P 500 against the two adventurous versions of our asset trackers and our wealth accumulator, the low cost passive asset trackers and the active range of our wealth accumulators. And this is a picture that you would expect to see based on the landscape, or the picture that I've just painted. It's been very difficult to outperform a concentrated market of the S&P 500. So this is a picture I would expect to see. And then if you just shorten that time horizon, if you go to the next slide, to the last 3 years, it's the same winner, but it's not as clear. And I'd just point out as well, obviously the S&P 500 is more concentrated to there's roughly 6,000 stocks in the two P1 solutions. But you can see the drawdown last year, the tariff tantrum drawdown just before and after April. And you can see relative to the two portfolios, you can see the risk inherent in the concentrated market. But I would make the argument in the US market as well, considering the new monetary policy environment we find ourselves in. And then looking back at the calendar year last year, you do see the picture shift. And again, I know it's a 1-year period, but my question is this the beginning of the US dominance dissipating somewhat? And you can see actually it's been our last year, our active range, the wealth accumulator range, has outperformed even our low cost range and certainly the S&P 500. And I'm wondering, have we entered an environment where portfolios that are effectively pricing risk, managers are pricing risk effectively, searching for real assets, are they going to start coming to the fore? And specifically considering decumulation clients who have sequencing risk to consider. If you look at the tariff tantrum there again, I know it's just a line chart, but you can see the wealth accumulators, the active range with managers pricing risk, they managed somewhat on the downside there. So specifically for decumulation clients, is there a thought to start allocating even a portion of their portfolios to more active solutions that are pricing risk effectively, considering the new monetary policy macro environment? And I think the last slide here shows my point really well. If you look at if you are defining risk as a standard deviation or annualized volatility, last year the wealth accumulators, the A over there, you can see it outperformed whilst showing a lower level of volatility. So that's indicative of those managers searching the markets, searching outside of the US market for opportunities that are undervalued and really pricing risk accordingly compared to some cost passive equivalents or certainly the S&P 500. And it's not to say, I think our low cost passive range, the asset trackers, is not a simple equity bond split, a set and forget range. We're also actively looking to position, as Will alluded to throughout the webinar. So I think you've got some really good solutions within P1 to I guess there's optionality when it comes to clients and their different needs when it comes to accumulation versus decumulation, for example. And just conscious of time, so I'll be quick in the next 2 minutes. Just a couple of really operational updates from P1 on the platform side. We've recently launched a multi-factor authentication, so really focusing on protecting client data even further there. We've really recently launched some advisor notifications off the back of feedback from advisors. And we've also rolled out some new user interface. So I guess you can wrap those 3 aspects up into, you should continue to expect P1 to push the envelope when it comes to our technology. And really, that's part of our DNA is striving to improve the technology and really use technology to make advisors and their clients' lives more easier and more efficient in that sense. And then on the MPS side, the investment management side, quick update there is that our MPS solutions are now available on the Platform One platform. I think we're available on, I think it's around 21 platforms now. So platforms aren't usually a barrier to using our MPS solutions. So that's a nice addition. And then final slide from me, we do run a webinar series, Time, Money and Invest webinar series, where we focus on running advice businesses in general and looking at ways to optimize and really to grow advice businesses. And we've got the upcoming one is with the Silverback Consultancy. It's the 3rd of Feb. And that's, again, just to summarize it, it's also focusing on helping ways in which advice businesses can be optimized and grown as well. So please join us for that if you're interested. Smack bang on the hour. Good timing. Thank you. Thanks, Will. Thanks, everyone. Thanks for joining. And we hope to see you on the next one. All the best.
Thanks.
Cheers.
Bye.